This is TreppWire Week in Review for the week ending March 22nd, 2024. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, the Fed raised its GDP and inflation outlook while maintaining its forecast to cut interest rates sometime this year. In CRE, we saw more retail news with Joann Fabrics filing for bankruptcy. Despite some of the uncertainty around the Fed's meeting and a few other negative headlines, equities continue to put on a good show, with all three indices hitting new records. So is the devil in the Fed dots, Stephen?
Absolutely. Great plug there. I got to say, I love the line, the devil's in the dots, because it truly is. If you had been reading the headlines leading up to this FOMC meeting, all eyes were firmly fixed on the Summary of Economic Projections, or the SEP. It was more or less a given that the Fed was going to hold. Really, the only interesting part of that announcement was Chair Powell's narrative about, how hawkish or dovish was he going to be, but ultimately the data points that the market was very fixated on was the SEP. So just to unpack some of what I think were some of the very major revisions that we saw relative to the December projections, the biggest one that stood out was the Fed's projection for real GDP. Back in December, they had projected real GDP growth would be 1.4% in 2024. They upgraded that to 2.1%. So, a huge jump up in what they thought economic growth was going to be for 2024. For 25, they upgraded it from 1.8 to 2.0. And in 2026, from 1.9 to 2.0. So basically, they think the economy is going to be chugging along in real terms, right around a 2% growth rate. They also became slightly more optimistic, just slightly, on the unemployment side, revising their December projection down from 4.1% unemployment to 4.0. The headline inflation rate for this year, PCE inflation, held steady at 2.4. And here's the interesting one that provides a bit of a tug of war or counter to their optimism around GDP. They think core PCE inflation will now be 2.6, and that's up from 2.4% that they projected back in December. And what I think is still very interesting in this mix of the real GDP and is that they still think they're going to cut 3 times this year. So it was a bit of a wash. On the one hand, we have good economic growth. On the other hand, it's that stubborn, rocky, last mile bit of inflation. And so they really didn't make any changes to what was going to be the most important piece here of the rate cut expectations. It's for all of us real estate folks, whether it's in residential or commercial, the big thing is, when will we start getting rate relief, a pullback from the above neutral rates, Fed funds rate? So a lot to go through there on the dot plots.
Yeah, so Stephen, I didn't think that you could make the dot plot cool, but I think you did a pretty good job there on the intro of viewing a lot of info from the dot plot and the narrative that's tied to that. I mean, it's almost like, are you a micromanager, or are you someone that trusts your team to get the results and really all you're judged on are the results? That's kind of the conundrum I think the Fed is in here. Is, are there 5 cuts this year? Are there 3 cuts this year? Well, honestly, it doesn't really matter if you get to the rate that everyone's hoping that you get to by the end of the year. And to your point, the dot plot shows 3 rate cuts instead of more than that, but effectively they're going to get the result that everyone is hoping for. It just may get there in a slightly different manner. A couple of comments from Powell that I thought were interesting, and I think this speaks to just that last mile going from 3% to 2% target range on the inflation side, is that he said they want to continue to see confirmation inflation is moving closer to the central bank's 2% target, even after a recent spate of hotter inflation readings. So he acknowledges that there was definitely some hotter numbers than what they had expected. And then if you look back, he said the other thing is, in the second half of the year, you had some pretty low readings, so it might be harder to make that 12-month window forward. And then lastly, nonetheless, we're looking for data that confirm the low readings that we had last year, give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%. So I thought it was interesting. I saw some commentary afterwards that said 3% is going to be the new 2% target. But if you listen to what he's saying, he mentioned multiple times that 2% is still the target and they just haven't quite got there. The other thing I'd be interested to hear your perspective is, he said a hot jobs market wouldn't necessarily prevent them from cutting the rate. And I think that's a slight pivot from what we've been hearing for the last 18 months or so, is that they're really keenly aware of the jobs market and unemployment broadly. And he basically backtracked a little bit, I thought, yesterday in saying that even with strong jobs, it doesn't negate their ability to start cutting rates.
Yeah, I think, and this is a difficult one to really piece together or reconcile when it comes to data, but we know we've had a lot of cross-border migration, and there's been some anecdotal comments made that that's helped provide some labor supply and wage growth relief in certain job sectors. So that's certainly something that I'm sure the Fed is acutely aware of. To your point, Lonnie, yeah, it's reassuring to hear them come out and say, basically, it's not going to take a recession to get deflation or disinflation to continue sustainably towards their target. I will say what's interesting to hear some economists or strategists at various investment banks or investment managers toss out there, because I've heard this a few times from a few different folks, that while it's great to have this sort of economic resilience, the fact that you have to stay higher for longer maybe increases the likelihood that we have something more than just like a soft landing, call it a medium landing, or some sort of a mild recession. It increases those odds because it's increasing the possibility that the Fed will ultimately have to over tighten. And to keep working backwards through some of the commentary we've thrown out here, 2% versus 3%, I've heard that so many times over the last few months. And at least personally, I'm in the camp that it would be a mistake to move the goalposts at this point, because the last thing the Fed really wants to see happen is for any additional degradation in their credibility, right? They missed it with the transitory inflation. They got beat up a lot about that, and also about the timing of starting the rate hikes. And so I think for them to come out and say anything like, oh, well, we ultimately think the neutral or sustainable level of inflation is maybe closer to 3%, would just be tossing too much uncertainty out there and ultimately damage their ability to control what the market's reaction function is to their forward guidance.
Yeah, I agree. And I know we have a couple of other topics we want to get to, but just one last thought on this to get your response is, this is an election year. Does holding off on cutting rates until closer to the election, does that start to like play into the equation, or the conspiracy theorist or whatever as it may be, that hey, the data's not changed that much. You could have started cutting rates at the beginning half of 24, yet you decided to hold off. And now here we are where it's a politically motivated, potential discussion.
Part of me says no, but ultimately I'm gonna have to say yes. Like, it will become political, whether or not it's political at all to begin with, because we just know how this will ultimately play out. I do believe the Fed is more or less like politically agnostic, because they're going to right now they are getting beat up by both parties, right? They're worried about losing their job from both parties. So I don't think they're in a very great position right now with the data not cooperating around the timing, because I'm sure they would prefer to see continued disinflation and be able to say confidently that we can cut rates now and avoid that closer to election time appearance of some sort of a conflict of interest. But it just doesn't look like it's in the cards for them.
Yeah, it's going to be interesting to see how widespread that narrative goes, because I'm with you. I feel like they want to be separate and indifferent to that, but the timing is just not lining up favorably for them. So there were a couple other things, Stephen, we wanted to touch on. We did see a tweet from a deputy economist from First American this week that talked a little bit about housing starts. So housing starts in February were at a seasonally adjusted annual rate of 1.52 million, which was above the consensus expectations of 1.4 million, which I think is a pretty positive sign. It's 10.7% above the revised January estimate of 1.374 million, and 5.9% above the February 2023 1.436 million. So there's some other driving factors behind this. Weather obviously can impact starts. So if you look at permit to try to get a better idea, permits are generally a leading indicator of future starts. There's a positive story there. Building permits were above consensus expectations. Expectations were at about 1.49 million, and they came in at 1.51. So just again, about 2% above the revised January number, and about 2.4% above the February 23 number. So I think, it's just really interesting. If we didn't have the mainstream media, if we didn't have Twitter, if we didn't have any of this stuff, and you just look at some of the other economic indicators, the markets are pretty strong right now. Not just the equity markets, but just like home starts and other things. It seems like the narrative coming out of most of those market areas or economic areas are overwhelmingly positive given where we're at in the cycle.
I'm glad you bring up the building permits and housing starts. On the permit side, and please take these numbers with maybe a teaspoon or even a tablespoon of salt here, because I'm rattling these off by memory here. But if you look at the breakdown of, I think it was the year-over-year numbers for multifamily, versus single family, it was something like single family was up 30% year over year and multifamily was down 30%. So we're finally starting to see that supply side catch up roll through building permits. And I have to ask myself the question of, are we going to end up in a similar place to what we saw happen coming out of the GFC, where we supplied too much, rents softened, you had some supply side issues as well, and basically we end up systematically undersupplied for housing yet again. And it certainly feels like we'll have a little bit of that, maybe not to the same degree we had in the GFC, because that was, zero liquidity, everything shut down, and you had PVC farms, all over the place. For those of you who haven't heard that term, a PVC farm is a piece of land where they scraped it, platted it, get ready to put in homes, and the only thing that's left is all of these stubbed up infrastructure, the PVC pipes sticking by the ground. It looks like you're growing PVC pipe. So I don't think we're going to end up at quite that level of shutdown, but I have to wonder.
It's amazing when that happened, Stephen, back in 07, 08, was those neighborhoods may have had a model home and had pre-sold or sold 5 or 6 houses. So you literally could have been one of the first movers into a neighborhood, and then everything went upside down and no one else bought or built in that neighborhood for another like 4 or 5 years. So you have these really awkward neighborhoods. We had dozens or hundreds of them potentially even in the Dallas-Fort Worth area, where you had 5 or 6 people living in a neighborhood that was platted for 200 homes, and it didn't build out for another 5 years post the initial construction. Really crazy.
Yeah, it ends up looking like a scene out of a Dr. Seuss book where the grickle grass grows and the air is foul,
Yeah, then you're faced with like, do you as the owner, do you go mow the other vacant lots surrounding your place because you want it to look somewhat decent, because there's no developer anymore that's coming out there and maintaining those things. So why don't you talk to us? I know we saw a headline from the FDIC kind of walking through the disposition of the SVB loans, that the 10.5 billion worth of loans that had been hanging out there for a while.
Sure. So yeah, we got this headline here this week that the FDIC is offloading $10.5 billion of SVB loans that had hung over the market. And so there's been this backlog of loans that the FDIC has had to work through. And the failure of Silicon Valley Bank and Signature Bank in March 2023 left the FDIC with a large portfolio of assets. And BlackRock, which was brought in to sell them off, offloaded most within a few months. But the FDIC through last year was still holding on to some $13 billion in face value of Ginnie Mae project loan securities, a type of debt that's backed by apartment loans. The amount rivaled the volume of new Ginnie Mae securities that are often sold in a given year, raising the risk of a fire sale that would upset the market. So the FDIC's annual report last month reported that it sold 10.5 billion of the securities in January to trusts tied to the Federal Financing Bank, an arm of the U.S. Treasury. The trusts sold notes to the FFB, though the precise mechanics of the transaction weren't described. So, it's good news, but also there's a lot that we don't know about this transaction. So I guess the good news is, hey, the 10.5 billion has been resolved. We just don't really know execution price.
Yeah, and the challenge with that too is there's a narrative, a bad look here in the sense that it was sold back to part of the Treasury. It's got the makings of a bailout, and it just doesn't look great. And so I think, I wouldn't be surprised if we start seeing some more details come up slowly on this one because of the negative optics. And so it'll be interesting to see what happens. To your point, like kind of a mixed green in the sense like it's been resolved. That's great. It's no longer black cloud hanging out over the market, but at the same time, not really arm's length and not really a great deal for the taxpayers who now basically take those loans on. So interesting kind of conclusion. We weren't sure how it was going to be resolved heading into this.
Yeah, and just to add just a brief bit more context here, if we were to compare this to what we saw happen with the AIG portfolio when a lot of those securities, and I'll speak to the CMBS side because I saw those liquidations in real time. When the AIG portfolio got taken over and the custodian basically looked at the book and said, okay, here's what you could sell it for today if you really want to digest these level of losses, or you can let us hang on to it and we'll have a pecking order and sell off and get the highest recovery value we can. And to me, that's sort of what's going on here. As they said, okay, look, if we had to liquidate these Ginnie Mae project securities in this market, this would not be best execution. So let's try and take a patient approach. We've had one of the most sophisticated players in the market help us out here and run the analysis. So to me, I'm going to lean into efficient markets. They've done the NPV analysis, and I think, hopefully this is just a case of they're trying to be as patient and maximize recovery to the best extent possible.
A lot of news this week, guys. So thanks for breaking that down. We're going to turn to our true commercial real estate story segment now. But before we get to that, I wanted to throw something out there. We released our latest analysis from our Trepp Property Price Index. So for those that don't know, this is our index derived from sales transaction data, and it uses a repeat sales methodology that measures changes in property prices by comparing sale prices of properties that have been sold more than once. So our findings in this latest report show that commercial property prices declined last year by 5.3%, and that prices are now 7% lower than they were at their peak during the first quarter of 2022. So if you're interested in this analysis and seeing more of our findings, send an email to podcast@trepp.com and we'll send you those results. And then we'll jump right into our property type segment for the week. Something we mentioned in the intro, but to kick it off, we wanted to dive into some retail news, specifically around Joann Fabrics, which filed for bankruptcy.
Yes, they are an important fabric of the retail. I'm sorry, that's a terrible joke. You can leave that in, Haley, but it's a terrible one. So I'll cut it off. But in all seriousness, the fabric and craft retailer Joann filed for bankruptcy, and at first blush, you would take this as, oh my gosh, this is negative news for the commercial real estate sector. They're probably going to be rejecting leases and evaluating their site locations. The good news here is that this Chapter 11 bankruptcy, which is a restructuring or reorganization situation, really was to recast or right-size their debt. So they had between $1 and $10 billion in liabilities, and effectively they were trying to reach a settlement or an arrangement with their corporate bondholders that brought down their debt to just over $130 million in new financing, which aims to halve their roughly $1 billion plus in debt. So in their announcement, they said, at least initially, they don't have any plans to shut down stores, with its roughly 850 locations staying open for business. However, us at Trepp, we've been through multiple market cycles and know there's always that risk that some of this does change and they end up saying, you know what? Let's go back and cut some of the underperforming locations while we're still in bankruptcy. That can make sense. So we took a look at their exposure, and there's roughly $2.18 billion worth of loans across 127 properties where Joann is a tenant. Joann did close 8 locations in 2023, so they've already gone through some of this rejiggering of their portfolio. So with their geographic exposure, Joann's exposure is the heaviest in Florida and CMBS. That accounts for just under 25% of their overall exposure. Now, when we dug deeper into the financial performance, the loans for these centers are doing quite well. Only 6 loans totaling $72.4 million have a debt service coverage based on NOI less than 1.25 times, with roughly 25% of that being in regional malls. So all in all, in terms of a cash flow basis, these properties are doing quite well. Now, if we look at debt yield, it casts a slightly larger shadow. Approximately 23 loans with an outstanding balance of $382.5 million have an NOI debt yield less than 10%. But again, regional malls account for about 30% of this exposure. So stepping back from this, all in all, it looks like the centers where Joann is at are performing quite well. There's probably not too much of a risk for CMBS investors. They're going to get clipped by what would be a surprise shuttering of some Joann's locations.
So, Stephen, I got to tell you, that intro joke that you just made had me in stitches. I think that might be worse. So yeah, I think you covered this one pretty in depth. I wanted to say, for those nerds out there like us that want to have some late night Friday evening reading, if you go to the most recently filed 8K for Joann and search for the keywords cleansing, there's some pretty interesting stuff buried in the 8K in regards to what you were talking about here. So there's some exhibits and some sections that kind of talk through what they're going through and what they might be doing and so forth. So, some interesting reading if you have some time this weekend in the 8K document. But yeah, overall, I think that they're in a much better position than some of these other companies over the last couple of months that we've talked about that are going to have, in the hundreds of store closures. I don't necessarily see that here. Although I wouldn't be surprised that we hear in a couple of months that there's definitely going to be some non-performing stores that are no longer open.
So let's get into some of the individual retail property stories that we tracked this week. The first one, we have the $221 million Woodbridge Center loan that resolved with $156 million in realized losses.
Yes, so this was a rough one. The loss severity on this particular story was 70.4% loss. So some background here, the Woodbridge Center loan that resolved with this 70.4% loss is a 1.1 million square foot retail space in Woodbridge, New Jersey. It's a mall that was constructed in 1971 and renovated in 2011. Now, the entire mall contains 1.6 million square feet of space, with 1.1 million serving as the collateral for this loan. Years ago, the mall lost Lord & Taylor, a non-collateral tenant, and Sears, which was actually a collateral tenant in this case. The loan transferred to special servicing in July 2020 for imminent monetary default due to COVID. We had most recently written about this loan in November 23 when the appraised value was reduced to 79 million, and the previous value had been 86 million. The collateral was valued at 366 million in 2014 and has been lowered 5 times in total. The debt service coverage on a net cash flow basis for this property had steadily fallen over time. In 2020, the loan posted a debt service coverage ratio of 1.77 times. That dropped to 0.95 in 2021, 0.42 in 2022, and 0.19 in 2023. And occupancy has hovered about 67 to 69% over the last 4 years. So a really struggling mall. Severity is obviously reflecting that trend in financial performance, coming in at 70.4%.
Yeah, this is one of those that gets close to land value at some point with those types of financials. Stephen, if you don't mind, maybe for our listeners that don't know, just give us some perspective on what you mean when you say collateral versus non-collateral. And I know it's applicable a lot of times in the mall space where you have some of these big box anchors, but it might be insightful for some of our listeners to kind of understand what the nuance is there.
Sure. If you think about your typical enclosed mall where you have the really large anchors, say Sears, Dillard's, Macy's, those giant boxes on the ends of the mall, oftentimes those are set up where the tenant actually owns the physical space and they will be on a ground lease. And so those individual anchor boxes are effectively carved out, even though they're attached to the main mall, the main part of the enclosed mall, they're actually carved out from the collateral. And so what you're left with is maybe a handful of other anchor tenants that are part of the collateral, and then all of the inline central space in that mall serves as the collateral. So as you brought up, Lonnie, in this case, we had a 1.6 million square foot mall with about 500,000 square feet across a couple of the anchor tenants carved out from the core collateral, that if the lender were to foreclose like they have in this case and liquidated it, ultimately what they're valuing or what their recourse is just that 1.1 million of the 1.6.
Yeah, so they may underwrite the ground lease rent that's attributed to those big box stores that are not collateral, but they're not actually, to your point, having any claim in the actual physical storefront there. So, and those ground leases are usually nominal on a relative basis. And so it's beneficial and creates synergies for them all to have the big boxes. That's why they have co-tenancy clauses and other things in place. Thank you for giving us some color on that. We do have another story here. This was Colony Center, 759,000 square foot regional mall in Albany, New York. Saw its appraisal value slashed. This property serves as collateral for a $103 million Colony Center CMBS loan. And this month, it received about a 30% reduction in its appraised value. Most recent appraisal was done in 2020 when the property was valued at $97.6 million. The original value at securitization in 2014 was at $145 million. And then the appraisal that was just done has the value of the property pegged at $67.5 million. So significant reduction over the last several years. We highlighted the loan's transfer to special servicing back in January of 24 after the loan was not paid in full at its modified maturity date in December of 23. So it's not uncommon for us to talk about these large mall loans that were originated 10 years ago, and they're headline worthy now because the maturity is come and gone. And this is an example of that. So this property is currently sitting as delinquency. So it's a non-performing matured balloon. This property was built in 66 and renovated in 2014. And fairly similar story to the previous mall that you talked about, Stephen. Debt service coverage and net cash flow was at 1.16x in 21. Had occupancy at that time of 78%. In 22, DSCR fell to 1.01x, even though occupancy had increased to 98%. And if you look at the first 9 months of 23, DSCR was 0.66x with occupancy at 90% for the first 9 months. So an interesting takeaway there is what that tells me, and then the numbers speak for themselves, is even with the increased occupancy, the mall owner wasn't able to actually start generating revenue from those tenants. So they effectively have some sort of a rent abatement or some sort of a lease up period where they're physically in the space, but they're not paying rent, as evidenced by the occupancy numbers shooting up, at one point to 98%, but DSCR coming down significantly. So it'll be interesting to see if they're able to get those tenants to actually start paying and see some recovery at this location.
And this is a fantastic opportunity for me to put a plug in for an upcoming guest podcast we have coming down the pipe here in the next coming week or so. So we're actually going to be having Pacific Retail Capital Partners, who is the sponsor behind this loan, on for a guest pod here coming up. And I think they'll be able to give us some really good insights. I'm excited for this guest podcast because there's a lot that we have to cover. So just know there's more to come on this story. And again, really excited to have them on.
Yeah, they have a lot of mall assets. And so it'll be great having another retail company come on the podcast and give us some boots on the ground perspective of how this asset class is evolving and how they're addressing some of the macro challenges that these assets face.
So keeping on the theme of appraisal reductions, we also saw the retail asset behind the $125 million 1880 Broadway / 15 Central Park West loan receive a 20% reduction in its appraised value. The CMBS loan is backed by an 84,000 square foot retail space in Manhattan's Lincoln Center neighborhood. The value dropped to $63 million from the previous appraised value of $79 million. That appraisal was done in 2022 when it fell below the loan balance for the first time. This property was valued at $195 million at securitization in 2012. In previous editions of TreppWire, we highlighted that this loan was the largest loan that failed to pay off in September 2022. Previous servicer watchlist notes before the balloon maturity date had indicated that the borrower planned to pay off the loan by the balloon date. But obviously that loan failed to pay off and was transferred to the special servicer in September 2022 following its maturity. For the first 9 months of 2023, the loan posted a debt service coverage ratio based on net cash flow of 0.89, with occupancy at 46%. The debt service coverage and occupancy on the loan have fallen from 2.02 and 100% respectively. That was posted in 2022. So a pretty big drop year over year. The full year 2022 NOI on the loan was $11.3 million, whereas the year-to-date NOI as of third quarter 2023 was $3.8 million. According to servicing commentary, Best Buy, which made up 54.4% of the space, vacated ahead of its January 23 lease expiration. JP Morgan extended their lease for 10 years, now expiring in 2033, with a mark-to-market renewal effective January 24. This renewal will also negatively impact the NOI on this loan because it's going to result in a $2.2 million drop in income annually. Servicing commentary suggests that foreclosure is being pursued while other workout strategies are also being evaluated simultaneously.
Yeah, that's a tough one. I mean, although if you've been in a Best Buy lately, it's really tough for them to compete with the e-commerce folks. And it seems like the last couple of times I've got to Best Buy, it's really them just selling cell phones, even though they've expanded their inventory to include appliances, hair care products. I mean, you name it, they have it, but it's a really tough deal. So when they occupy 54% of your space and vacate, that's a tough backfill as well. So we'll see what happens with that property. We did have some activity down in Florida. So for a Miami mall, back in February, we discussed that the $158 million Miami International Mall loan was transferred to special servicing when it failed to pay off at its scheduled maturity, noting that the borrower is working with the special servicer for a forbearance. Fast forward now to March, the lender and borrower have agreed on a 1-year forbearance period, which will extend until February of 2025, with a 1-year extension option all the way out to February of 26. The loan currently sits delinquent as a non-performing matured balloon status, Workout strategy in the commentary notes on the loan show that the loan is pending return to the master servicer. So I guess this is another one that's kind of a mixed green in the sense that they missed their maturity date. They were delinquent. They've now been given at least a 1-year automatic forbearance with an extension option for an additional year. The collateral on this loan is about 300,000 square feet of roughly 1 million square foot regional mall in Miami. It was built in 82 and renovated in 2001. Typical mall tenants here, the top tenants include H&M and Old Navy. Both of them have lease expiration dates in January of 2025. I would assume that the lender has some indication of them renewing at this point to grant the forbearance. Details of the forbearance stated that in the servicing commentary, there were loan paydowns from the borrower to deleverage the loan, a full cash sweep on the loan for the entire forbearance period, and for the event of default, cooperation covenants as well as default interest. So what that means is that the borrower will pay down an initial amount of $2 million with another pay down of $3 million in the event that the 12-month extension option is exercised. So again, we've talked about this for the last several months with a lot of these office properties, but we're seeing it here on the mall side. $5 million pay down effectively over the next 24 months is a pretty significant move for the lender from the borrower. And then as far as the cash sweep goes, excess cash will be split 50-50 between the lender and a reserve account and a hyper amortization of the outstanding principal balance. This one has healthy DSCR in 2023. It posted 2.34x when occupancy was 79%. And so it'll be interesting to see. The commentary here said the borrower had no ability to refinance or pay off the loan. So I think this is kind of one of those situations where the lender tried to take the least bad case outcome, I guess, some way to phrase that, of effectively getting some cash up front, having a nice, cash sweep in place, with the ability to collect another $3 million should they exercise the extension in 2026.
Yeah, without digging too much into the details right now, you can kind of see surface level with the lease expirations. There's probably some insurance or operating cost things to get fleshed out. There's probably just a number of items that need to get resolved here. But like you said, Lonnie, this is an incredibly healthy DSCR. Miami is a market that's been doing extremely well. We know how much migration there's been down there post-pandemic. And ultimately, when you look at the terms, a full cash sweep is pretty punitive if you're the borrower. And so agreeing to that makes me think, there's hopefully some good news around the corner here if they can just get those lease extensions inked and resolve any other outstanding items that maybe you're keeping this loan hung up and impairing its ability to refinance.
So let's turn our attention to the office segment. We pushed out a trading alert this week on the news that LinkedIn was putting up more space for sublease in San Francisco.
So according to the San Francisco Business Times, LinkedIn is looking to sublease 51,000 square feet of its office space at 222 2nd Street. In October of 23, we noted that LinkedIn was making 63,000 square feet of space available for sublease at the same property. Now, the good news here is that, surprisingly, given that we've had so many negative headlines come out of San Francisco, LinkedIn was successful in subleasing this space. So in December of 2023, we highlighted that Silicon Valley Bank was planning to take over about 60,000 square feet of the 17th through 20th floors of that sublease. And now we got a report that SVB has in fact opened this office location. And furthermore, some more good green shoots here. Early Warning Services, which owns Zelle, the payment app, subleased the 25th floor in a deal that closed in late 2023. So we'll have to stay tuned here for whether this new subleased space can get similarly backfilled. LinkedIn had almost 100% of the space in this 452,000 square foot office that was built back in 2015. And LinkedIn had actually signed a pre-lease on this building, I think 2 or 3 years before it was delivered. And so they have a staggered lease schedule with leases ending in 2025, 26, and 27. So in total, LinkedIn has now put up roughly 115,000 square feet of space, or more than a quarter of this office tower, up for sublease in the last 6 months. And this property backs a $291.5 million loan that is split between 3 2017 CMBS deals. The loan has been current throughout its entire life and has an anticipated maturity date in late 2027 and a legal final maturity date in 2029. So just as some quick inside baseball here, if you haven't heard of an anticipated maturity date, I said, there's an anticipated maturity date of 2027 and a final maturity date of 2029. What typically happens with these ARDs or anticipated repayment dates is that if the loan is not paid off, it can legally roll past its maturity date, but what happens is there's some automatic triggers that get put in place, and usually a lot or all excess cash flow gets swept and the loan starts hyper amortizing. You heard us talk about on that forbearance situation earlier. And so it hyper amortizes up until that legal final maturity date of 2029. So it's a nice little backstop. You see this every so often. It's not, I would say, the most common contractual feature, but it is fairly common in CMBS.
Yeah, just reiterate the point of if you're taking out a CMBS loan, read the loan docs, because you got to make sure you understand, because a lot of people probably don't understand all of that. And then when they start getting notification of hyperamortization, it freaks them out and they don't know what to do, and it's too late at that point. So we also saw a few loans backed by office properties get sent to special servicing. So I'll run through these here pretty quickly, Stephen. 151 million, 65 Broadway loan has been transferred to special servicing for the quote unquote imminent maturity default that we see so frequently. It says a scheduled maturity date of April 24. The loan has been current through the entire life of the loan, but it's anticipated that it won't be able to pay off at maturity. It spans 355,000 square feet, was built in 1914, but renovated fairly recently in 2018. If you look at the trailing 12 months up to September 23, loan posted 0.96x DSCR and occupancy was 67%. We also had one in New Jersey, 129 million Princeton Pike Corporate Center, was transferred to special servicing for imminent monetary default, not maturity default. This loan doesn't mature until January of 26, but commentary states that due to occupancy decline, the borrower is not making sufficient cash flow to make debt service payments and other operating expenses. This fits the narrative. Occupancy was 60%. DSCR was 1.16x for the first 9 months of 23, and fairly significant drops from the previous years. Collateral on this property is 809,000 square foot in Lawrence Township, New Jersey, was built in 78 and has been renovated, had an appraised value of 199 million, which was given at securitization. And the loan has been with special servicers since April of 2021. Did have a modification in September of 21, which included an interest-only conversion and ongoing cash trap through payoff, and the loan was returned back to the master in November of 21. So some interesting deals here. We'll see what happens with both of these properties, but at least at this point in time, some headwinds for them, I guess, to say the least.
So to wrap up our office segment, we're going to close with a transaction here. We have a health provider paid $11 million for the Broward Health office property. That's let's call it a 41,000 square foot office building at 9600 West Sample Road in Coral Springs, Florida. The sale price of $11 million equated to roughly $269 per square foot, and this story comes to us from the South Florida Business Journal. The South Florida-based public health system purchased the 5-story property from Eden Sample LLC of Miami, which had bought it in 2018 for $5.8 million. The new owner will use this property for medical office purposes.
So let's shift gears and talk about some multifamily transactions that we saw across the country this week.
So a lot of activity here. I'm going to run in and I'm going to front run this one from you, Stephen. Phoenix area apartment property sold for $94.5 million. This was a purchase by Olympus Property. They paid about $324,000 per unit for the 291 unit Alta Chandler at the Park apartment, which is in Chandler, Arizona. Olympus Properties is based in Fort Worth and purchased the property from its developer, which was Wood Partners out of Atlanta. Marcus and Millichap arranged the financing, which included a $52 million Freddie Mac loan. And they opened last year, so this is a new construction property, and it sits about 21 miles south of Phoenix. We did have another sale here, a Chicago apartment property, which sold for about $288,000 per unit, or $144 million in total. This was an affiliate of FPA Multifamily that purchased the property. It's a 500 unit apartment property. This was according to Crane's Chicago business. San Francisco investment manager purchased the property from CIM Group, which had developed the property with Murphy Real Estate Services in 2019. This property cost $171 million to construct. And in 2019, Deutsche Bank provided $148 million in mortgage financing. This was for Paragon Chicago was the name of the property, which I had not mentioned. So this was a negative in the sense that it cost $170 to construct in 19, and here we are in 24, property trading at $144 million. And then lastly, Stephen, I'll jump on one more and get your thoughts. Fairfield Residential has bought Priest Lake, a 300 unit apartment complex in Nashville, Tennessee. for 45.2 million or 150,000 per unit. This is according to Nashville Business Journal. San Diego investment manager purchased the 3-story property from GVA Real Estate of Austin, which had acquired it in 2015 for 23.3 million. So this one is counter to the negative narrative around Nashville, where they were able to successfully exit a property for effectively twice what they paid for it after about a 9-year hold. So some good news coming out of Nashville on the multifamily side with this story.
Yeah, and for some of these hot markets, I mean, honestly, time is all about perspective here. So the longer you've been in the industry, 9 years doesn't seem like a lot. The younger you are, you're like, oh my gosh, a 9-year hold. But in a hot market where you tend to see properties trade hands so frequently, a 9-year hold is a pretty long time for something like this. So yeah, I agree with you, Lonnie. Good to see some positive news come out of Nashville, because we've had some, I would say crabgrass type headlines almost out of some of the markets that have been the hottest, ranging from a lot of the Sun Belt, Miami, Nashville. There's a good Wall Street Journal article on Austin that was put out this week that plays right into that narrative of we oversupplied, and now you're starting to finally see that supply side catch up in prices and rents adjusting down.
Okay, and we have some lodging stories this week as well.
First, we'll start with the good news, a nice benign transaction. So first up, we have a Glendale, Arizona hotel selling for $23.75 million. Bradford Allen Hospitality Investments has paid roughly $237,000 per unit for the 100-room Aloft Glendale at Westgate Hotel in Glendale, Arizona, according to REN TV. The Chicago investor purchased the property from HCW Hospitality and Development, which was represented by Cushman & Wakefield. The hotel at 6920 North 93rd Avenue was built in 2019, includes a swimming pool, fitness center, bar, convenience store, and meeting space. Now on to the crabgrass here. We have an Ashford hotel portfolio loan sent to special servicing. So March 2024 remittance data shows the $345 million Ashford portfolio loan has been transferred to the special servicer. Servicing commentary from previous month had noted that the borrower was expected to make a principal paydown to meet the debt yield threshold requirements to execute the maturity extension. So pausing here for a second, these loans with extension options, where say it's a 3-year term with 2 1-year extension options, to exercise either the first or the second, and it really depends on the structure here, it's very loan specific, but there will oftentimes be a requirement that says the debt yield or debt service coverage ratio has to be at or above a certain threshold, basically saying that the lender or the debt investors don't want to be put in a situation where an underperforming loan is able to extend and ultimately extend into what could end up being a very bad situation for the debt investors. So the loan now shows at its February 2024 maturity date, the borrower exercised the last of 5 1-year extension options, pushing the extended maturity date to February 2025. The loan payment for March 2024 has not been received, but the loan still remains in its grace period. Servicing commentary states that the workout strategies are currently being reviewed. In 2023, the loan posted a debt service coverage ratio of 0.84 times based on net cash flow when occupancy was at 69%. So not great debt service coverage ratio, but the occupancy is kind of in line with what you would expect for a limited service hotel portfolio. The collateral backing this portfolio is 8 hotel properties across Oregon, California, Florida, Virginia, Minnesota, and Maryland. Embassy Suites makes up the majority of the hotel portfolio. The largest allocated loan balance is 22.39% for Embassy Suites Portland Downtown. Across all the hotels, there were 1,964 keys in total. All hotels have been renovated except for one.
So, Stephen, that Ashford hotel portfolio loan, I remember at the beginning of COVID, they had a really large portfolio exposure, and they were actually able to divest some of those assets and I think get some of them back on in good standing. And then now they have this kind of gone back to special servicing. They're nimble. They understand the market. They understand the dynamics. I'm hopeful that they can figure out a way to get this loan and these properties situated in a productive manner for them and for the CMBS investor. So we'll keep an eye on this, definitely be providing more information as it becomes available.
And finally, we're closing with the one everyone requests, industrial, and we have a few stories there.
So yeah, the industrial sector is definitely the most coveted sector, both in practice and on the podcast. So that's why we round the podcast out with it. So joint venture between Westfield and Reinsurance Group of America acquire Center Park, a 431,000 square foot industrial park in Denver. This property was sold by Prologis. They used Cushman and Wakefield to broker the transaction. Center Park Properties, built in 2004, Class A industrial assets that are comprised of 3 buildings, fully leased to 10 tenants, including notable tenants Outdoor Edge and Matera. This property last traded in 2007 when Lowe sold it in a $38.4 million portfolio transaction to DCT Industrial. In 2018, Prologis completed its all-stock acquisition of DCT Industrial Trust for $8.5 billion, including the assumption of debt and assumed ownership of the existing assets across the U.S., which included, obviously, Center Park. These 3 properties are spread across 22 acres. It's a mix of flexible tenant sizes, functional column spacing, and really good parking. And so this is another great story for the industrial sector. Denver ranks second in the Western markets for sales volume in 2023 with $210 million worth of sales recorded. That information comes to us from a tweet from Daily REIT Beat. And so really good insight into that transaction. And then we did have a couple of others here. Ohio Industrial Property, Groveport South Logistics Center, 640,000 square foot industrial property sold by a venture of CA Industrial Properties and Stoughton Industrial for $56 million or $87 a square foot, according to Real Estate Business Online. So we'll round out today's episode with this last industrial story. San Diego Shallow Bay warehouses were sold. PGIM Real Estate provided a $51 million loan to fund the BKM Capital Partners $70.2 million acquisition of the Canyon Industrial Center, 199,000 square foot in the Kearny Mesa area of San Diego. BKM, which is of Newport Beach, bought the 13-building Shallow Bay property from RREEF America, or RREEF America, which was represented by Cushman and Wakefield. This is a property spread across multiple addresses, built in 1979, includes about 61,000 square foot of office space, as well as 49 units that range inside from 552 square feet to almost 19,000 square feet. Has clear heights from 14 to 20 foot and 56 grade level doors with 7 dock high doors. Very close proximity to 3 major freeways, Interstate 15 and State Routes 52 and 163. This is interesting, Stephen. PGIM funded the floating rate loan through its Core Plus lending platform. So you are still seeing some floating rate deals out there. And I wonder on some of these larger transactions, if it's because they're banking on some rate relief in the upcoming rate cuts and maybe that transitioning into some sort of a favorable position, or if they just feel like that's the best course of action given today's fixed rate environment.
Yeah, I mean, I think certainly depending on your exit strategy, with floating rate typically having more flexible prepayment terms, that can make a lot more sense than locking in, say, 5-year debt that might be less expensive, but have more restrictive prepayment structuring there. So yeah, it's very case dependent, but I mean, to your point, Lonnie, it is interesting to see a floating rate loan get done because right now the curve is still inverted. So when you go shorter, your interest rate ends up going higher. Anyway, to your point, yes, great to see Core Plus floating rate loans still getting done out there. That's right in line with what we've been saying, that liquidity, while it's not great, it's not as bad as what, maybe some of the headlines would make us think.
And we have a few programming notes this week. It's that time again where we have Trepp webinars coming up. So next week on Tuesday, March 26th at 3 p.m. Eastern, we'll be hosting a training session for our Trepp CRE clients to help them evaluate lease expirations and refinance risk. We'll have experts walking through how to identify expiring leases within maturing loans, how to unlock insights with our leasing dashboard, and also how to track vacancy and operating expense trends and their impact. So if you're a client and you want to sign up for that, send us an email. If you're not a client and this sounds interesting to you, send us an email and we'll connect you with a rep who can walk you through this on your own time. And then we also have our Market Pulse webinar. So if you don't get enough of Lonnie and Steven on the podcast, you can hear them on Thursday, March 28th at 1 p.m. Eastern, where they will cover bank CRE loan performance, which is through our bank consortia. We'll also talk about new CMBS issuance in the first quarter, fixed versus floating rate loan performance trends, and more. So if you're interested in that one, that's open to the public, and you can send us an email to podcast@trepp.com and we'll get you the link to sign up. And then turning to shout outs, we heard from David B., who's a software engineer for the CRE business line at a bank, who's a big fan of the podcast. Kroger P. appreciated this discussion on B and C properties and added that it matters not whether a property is A, B, or C, but whether the location, the basis, and the debt level allows the property to be operated profitably. Tom W. actually reached out to us about doing a live podcast and a panel presentation. So we met with Tom and his team this week, and we are going to make that happen. I don't know if it's announced yet, but stay tuned for more info on that. And thank you, Tom, for being a big listener of the podcast. We owe you some Pro V1 golf balls. Mike J. works with a client of ours and was interested in our daily CRE newsletter. So if you're not signed up for that yet, reach out to us. We have a lot of listeners who turn from just a listener to a reader. Cody H. was reaching out to see if the podcast crew will be at the CREFC conference in June. And yes, we will. We're always there. This year, we'll have a booth space, and we actually booked a few of the larger meeting rooms. So if you're interested in meeting with us in June, it's coming up shortly, and we can start booking times to meet with you guys now. And then our friends, Revan Capital, tweeted at us. I think this is about that story that we said might be a mixed green last week, but they said that Chicago office building's new valuation was all crabgrass. So we had mixed thoughts on that one too.
Yeah, mixed thoughts, but also a good way to just ensure we're getting that feedback and engagement that we so dearly love and appreciate. So yeah, love
So you're
that.
saying that was clickbait, Stephen?
No, I would never do such a thing. How dare you?
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.